A temporary rate buydown? Hey, what's going on, everybody? Today we're talking about temporary rate buydowns. But first, if you like my channel and you like my show, please do me a huge favor. Click on the like button down below and also subscribe to my channel. And if you really want to know when these videos are coming out, which I try to put out almost every Tuesday and Thursday, go ahead and click that little bell next to the subscribe button, and that'll help get you alerted to when the videos are going to come out next. But thanks so much for sharing. As always, my goal is to try to become the #1 loan officer on YouTube. I know I've got a long ways to go. I appreciate all the comments. I appreciate all the feedback that you guys provide in my videos. And if you can keep doing that, that would mean the world to me. Okay, today we're talking about a really kind of a cool technique called the temporary rate buydown. There's a couple different options for this. You may have heard it before. It was really common back before the financial crisis. I saw a lot of people doing this, but it kind of went away for a long time because it doesn't always work. It only works in a market where buyers have a little bit of an upper hand. It doesn't work very well in a really dominated seller's market. So you kind of need some the market to be correct in order for you to use this particular strategy here when you're buying a house. So a temporary rate buydown means that the seller is going to help you pay for a mortgage to be lower in the first year, 2 years, or 3 years, depending on how you negotiate the buydown. So there's such thing as what we call a 3-2-1 buydown, a 2-1 buydown, or a 1-0 buydown. And what that first number means is the number of years, or excuse me, the percent of interest rate that's going to be reduced on your mortgage for the first year of your payment. And then the second number means how much your mortgage interest rate is going to be reduced in the second year. And then if there's a third number in there, it's how much your mortgage interest rate is going to be reduced in the third year. I haven't seen them go beyond 3 years. I don't even know if it's possible if you can go beyond 3 years on a temporary rate buydown, but let's kind of strategize and figure out what they mean. So here's an example. Let's say we're doing what's called a 2-1 buydown. That means that in the first year of your mortgage payment, it's going to be 2% less than the actual note rate that you have on your mortgage. And then in the second year that you make your monthly payment, it's going to be 1% less than the actual note rate on your mortgage payment. Now, do you think that that would be beneficial for you to kind of ease yourself into what your mortgage payment is going to be, especially in the higher interest rate environment? The answer is probably yes. You're definitely going to have an advantage when you have a lower payment going forward like that. So how do you figure out what that payment is, right? Or how do you figure out how much the seller has to contribute in order for you to make that payment? So what we're going to do, it's a simple little calculator that we have as lenders. Not everybody does this, so make sure that you reach out to the right person. If you don't know anybody, I can help you out with this. But the first year, let's say you're doing a 2-1 buydown, and let's say we have an interest rate of 7.5%. That's your mortgage interest rate that you're going to get. And the first year's payment is going to be 5.5%. So that's 2% less than the 7.5%. So we would want to figure out what the monthly payment difference is between a 5.5% interest rate and a 7.5% interest rate. And that's a 1 month difference. And we multiply that by 12. So whatever that number is going to be how much we need to collect for the first year. And then the second year payment is going to be 1% less. So a 6.5% mortgage payment the second year versus a 7.5% fully amortized interest rate that you have. Whatever that payment difference is, we're going to add all those payments up for a whole year. And that's going to be the amount of money we need to get from the seller as a credit to help us buy down this interest rate temporarily over time. Okay. So this is a really cool strategy, guys. If you can get the seller to help you pay or subsidize your monthly payment, you can actually have a payment that is 2% less and sometimes 3% less in your first year. It can be 1 or 2% in the second year, and then even 1% in the third year if you can get it a 3-2-1 buydown, if you get enough credit to be able to do that. So that is a sweet way to like roll yourself into a mortgage payment, ease your way into the fully amortized interest rate. Now, here's the crazy thing about this, which is really cool. Because the seller is paying for it, you can actually refinance this loan if rates go down in those first couple years. Let's say they go down 2% in that first, 24, let's say they go down 2% in 1 year. You could actually refinance this loan, and then whatever money is left that you collected from the seller to help you buy down that interest rate every month actually goes to your principal balance, and you don't have to pay that because they paid for it for you, which is a sweet deal. So if you have any questions about this 2-1 buy down or a temporary buy down like this, or a 3-2-1 buy down or a 1-0 buy down, and you're trying to figure out how to do this and you need more information, let me be the resource for you. I'd be happy to show you and calculate how to do this. And then that way we have a strategy going forward. You're going to buy a property to help you get a really good deal, because you're going to be paying less than what market interest rates are right now, as mortgage interest rates remain pretty high here at the end of 2023. Okay. Any questions at all about this, guys? Go ahead and click on my calendar link down below. Let's have a chat. Let's have a call. Let's talk more about temporary rate buy downs and see if it's something that we can help you out with. Have a great day, everyone, and I will see you on the next show. Bye.